We'll get to the next round and potentially advance here. So please, again, download the app and get your votes in. And I will move on now to the next panel as we load in some stuff, which is going to be on equity crowdfunding. Now, non-accredited investors can now participate in entrepreneurial success stories, which has been disrupting traditional early-stage funding. This panel is going to explore the legal implications, capital opportunities, and other ins and outs of Jobs Act Title III equity crowdfunding. So please help me welcome equity crowdfunding lawyer Doug Elinoff, entrepreneur and crowdfunding expert Jerry Stengel, Seed Invest Pelly Wang, and our moderator, Kat Clifford of Entrepreneur Magazine. Panel, come on out.
Thank you.
Thanks, guys.
Wow, awesome. Hello, how is everybody? Oh, good. Good. Welcome, welcome. So we are going to talk about a new early stage funding mechanism, equity crowdfunding. And we have a rock star panel here. These are really experts, so I'm really excited. My name is Kat Clifford. I'm a senior writer at entrepreneur.com. I've been covering equity crowdfunding and all kinds of crowdfunding for years. Recently launched a web show, Crowdfund with Kat. So check that out, hashtag Crowdfund with Kat. Let my panelists introduce themselves.
I'm Jerry Stengel. I'm founder of Ventureneer, and I believe that entrepreneurs are going to solve all the problems of the world. And they're going to do that through innovation, creating jobs and prosperity for themselves, for their employees, as well as their community. And I help large corporations, foundations, and government agencies reach those entrepreneurs through thought leadership and branded opportunities.
My name is Doug Elinoff. I'm a securities partner at the law firm of Elinoff, Grossman & Scholl. We work very closely with the Securities and Exchange Commission and FINRA and foreign regulatory authorities and the commercial parties doing crowdfunding in the United States. And I'm chairman of a legal tech app focused on crowdfunding called idisclose.com.
My name is Pelly Wang. I'm a principal at Seed Invest. We're one of the leading equity crowdfunding platforms in the US. We're based in New York, and we were very instrumental with the passage of the Jobs Act. We're really excited that retail crowdfunding is now legal for small and medium-sized companies, and that's why we're here.
And you will know what some of this means by the end of this panel if all of that didn't totally register. So let's start off, first of all, in case not everybody knows, what is equity crowdfunding? And Doug is going to start us off here.
Sure. So just by way of quick background, after the financial crisis of 2008, where there was even more of a funding gap for startup companies and early stage companies than had been for the 20 years that I've been practicing. Even before that, the Jobs Act is supposed to respond to that problem and help entrepreneurs and startups have easier access to capital, largely online. And there are three provisions that Congress and the President signed into law in 2012 called Title II, III, and IV, not to get too technical. But they're all means by which, for the first time, entrepreneurs have an easier time raising money. I will go quickly through each of the three titles, so when we speak shorthand, you won't feel left out of the party. Title II is a private placement like private placements have been done for years since 1933, but it allows an entrepreneur who's seeking to raise money to do what's called a general solicitation, like a public offering. They can tweet about it. You can stand in the middle of Broadway here and say you're looking to raise money, or if I was looking to raise money, I could do it on this stage here. And you're allowed to do that, which you wouldn't have been able to do previously because it was a private placement. Title II, otherwise known as 506C, permits you to do a general solicitation so long as you reasonably verify the accredited nature of the investors who are participating in your investment. That is not just a tagline, that is a requirement. You have to get third-party verification that the investors who are actually investing in your deal are allowed, that have the net worth or income to do so. You can't accept foreign capital. This is a US program, it's a US exemption under the securities laws. This is the sale of securities, it's highly regulated. And so that's what Title II is. Title III, which has a lot of the buzz because the rules just went into effect 2 weeks ago, May 16th, allows any entrepreneur, U.S. entity, to raise up to $1 million through a FINRA-approved funding platform. And that $1 million can be raised in small increments from any American, whether or not they are accredited or unaccredited. So any American can invest up to $2,000 regardless of income, and then after $40,000 of income or net worth can put in 5%, and above $100,000 it's 10%, and there's an annual 12-month rolling cap of $100,000. Those funding platforms have diligence responsibilities to some limited degree by statute and the final rules, but you can do a semi-solicitation as an entrepreneur to attract attention to your deal and get people excited and go onto your platform and raise money. That's Title III in a nutshell. There are a lot of details. It's very complex, and you got to be mindful of all the rules. But it really is fabulous for entrepreneurs to be able to solicit their affinity groups through social media and otherwise. Title IV is what's called Reg A+, which allows an entrepreneur to raise up to $50 million, but just because you can doesn't mean you will. It's complicated again. It's much more expensive to conduct a Title IV campaign. Pele and Pele's firm, Seed Invest, do a lot of that business. They'll share the details with you. But if you go through the process, well, you can test the waters before you file with the SEC and see whether or not there is a sufficient amount of interest that you want to undertake the Reg A+ process and spend the money with lawyers, accountants to do what's necessary to file a prospectus-like light document that has to be reviewed by the SEC, commented upon. It takes about 60 to 90 days, but at the end of that process, if you prevail, which you no doubt will, you can solicit money from any American, again, accredited or unaccredited, because it's gone through a full SEC process. Those are the three provisions in a nutshell. I beat my time frame, right?
Yes, that was good, actually.
Okay.
That's a lot of detail right up front, but this is a pretty, detail-oriented topic. Just out of curiosity, how many of you had heard about equity crowdfunding before this? It's a little dark out there, but I can kind of see. Okay, that's pretty impressive.
That's a great number.
That's a pretty high percentage. A lot of audiences, you get maybe one or two hands, so. That's good. All right, so the laws surrounding equity crowdfunding have changed. You mentioned May 16th already, so Doug is doing a lot of our warm-up here for us as the lawyer. But one more for you. So how have the laws changed, and what are the implications of those law changes?
Well, I think the biggest change, which I was suggesting earlier, is that, and we're going to focus on Title III today, since we're very proud of the work that we've done in that area, which I think is the most helpful for the startup community in particular. And $1 million goes a lot longer for startup companies. And it's not exclusively a startup statute. It can be done, used for small businesses anywhere in the country, and it can be a debt financing as well as an equity financing. We think that Title III will be meaningfully used with debt securities. There are 10 currently approved funding platforms by FINRA that have already started to post their deals online, including again, Seed Invest, as well as others. There are 40 posted deals already conducting Title III campaigns that have filed their Form C filings, which are their disclosure documents. Most of it is equity, but some of it is debt. There is startup exposure in there, but there are also small businesses that are raising debt capital. And the range of companies is really quite broad. And what I'd like to emphasize, because I think there's a lot of misunderstanding about where Title III is applicable or not, as well as Title II, truthfully, it's not intended to replace venture capital. If you can get venture capital, God bless you. I mean, that's wonderful. That means you're in a rarefied group of profiled companies that are exciting to the VCs that you can take that kind of capital, and you have that type of multiple expansion over the next several years, so you'll have a great exit. But for many thousands of other entrepreneurs that have startup, they're only looking to raise a few $100,000. Title III is a wonderful opportunity to consider whether or not you choose to do it.
Okay, and also the rules changed on May 16th regarding who can invest.
That's correct. Title III allows any American, and I emphasize American, because it is a US statute. It doesn't mean Canadians or UK citizens are allowed to invest through these platforms. Most people don't focus on that. But it allows any American to put in a couple $1,000s to support these entrepreneurs. So the way I look at it is I think it's largely a friends and finance funding mechanism that's being done online in a more efficient, transparent way than friends and family offline at a barbecue or in a bar. And so I think the compliance capability by doing it through a funding platform is much greater. It also suggests to me that there will be much less problems or many fewer problems than a lot of established capital market participants like to portray it, because there's real disclosure that's going to be involved here that allows the regulators to look to see how the platforms are constructed before they approve them, to make sure that all the statutory requirements are present. So anybody can participate, to your point, and I think there are going to be many fewer problems than people perceive. And one last point, in the last 2 years on Title II, as controversial as Title II was, which is the accredited crowdfunding provisions, over $1 billion have been raised online. There's been one problem, and half of the capital was returned because the SEC could move in quickly, because there's transparency when it's done in an online format. So there haven't been the problems in Title II, and I certainly don't expect them to be in Title III. There will be investor losses. I'm not saying that there won't be, but that's true in all startup communities and friends and family finance.
Okay, so really good overview, Doug, thank you. So Jerry, for entrepreneurs, what does this mean? What does this new generation of equity crowdfunding mean? Why is it important?
Okay, so as Doug said, if you can raise venture capital, go do it. Only about 1% of all small businesses will raise venture capital. Maybe 3 or 4% of companies will raise angel investment. For the rest of the country, 97% of small businesses, Title II is a perfect fit. So these aren't the high exponentially growing companies, not the Ubers, not the Googles and the Facebooks of the world. These could be a yoga studio, it could be a restaurant raising money to expand locations. It could be Main Street companies. It's more of your everyday business that is interested in growing and wants to do it by raising capital and is willing to give up a portion or a share, although they could also do debt, so they have a choice, but they want to raise outside funding to grow. But my point here is they're not the super growth companies, they just want to grow.
And this is for Title III? Title III. Title III. And what about, so you mentioned there's sort of a distinction between 2 and 4 and Title III.
So Title II and Title IV are geared towards the high growth companies. So Title II, you're raising money from accredited angel investors, and those companies might go on to be, as I said, a Facebook or a Google. Those companies are going to be billion-dollar companies, some of them, or some of them may be hundreds of millions of dollars. Title III is going to be more focused on the companies that might be $10 million. Title IV is also aimed at growth companies as well. So I'm not sure, would they be billion-dollar companies or $100 million companies, but they're still high growth companies, just not to the degree of Title II.
So we've talked about a lot of sort of pretty complicated stuff here, but I want to turn to Pelly now to really kind of give us some examples, some real life examples of all of this language. Tell us a few companies that have used it and how it worked for them.
Yeah, so we work with a lot of companies that came from Kickstarter, and a lot of them have these great communities. So a great example is a company called Virtuix. They're in the virtual reality space, and there's a really good example of a company that was supported by their early supporters and then ended up getting purchased purchased by Facebook for $2 billion, which is the Oculus Rift. They're coming to market in the next few months. And Virtuix, they make a similar platform. It's complementary to the headset, and they got great support from their initial community. They came to us first to do their seed stage deal. They decided to use Title II, which is for accredited investors. This is 2 years ago, and they raised $4 million that way. They were able to develop their product, and now they're shipping and growing their distribution. So they decided to come back to us 2 years later and work with us on their Reg A Plus deal. They're in the market for their Series A round, targeting $10 million. And again, they went back to their supporters saying, hey, you guys were the ones that initially supported us, believed in our vision, we've delivered the product, now we want to expand to new markets, build new products. And they got about $5 million from their community as well. And again, the idea is that they can do this because people really believe in their products, and they want to build that customer sort of reward loyalty with their base.
I want to actually expand on something that Pelly said, and it was a point that was made to me at another panel where I was on with Doug's partner, Georgia Quinn. If you can, you want to start with a rewards-based crowdfunding campaign. And the reason you want to do that is because you're not giving up a stake in your business, and you're not, and you don't have to pay back interest. Later, when you need to, that's when you bring in the accredited investors, and you might do a Title II. And again, Title III is a little bit different because it's growth businesses, but it's lower growth businesses.
But let me just add to that, because I think it's a great point,
Yeah.
is the other thing that the Kickstarter Indiegogo pre-order campaign does, it validates for any money, whether it's a Title III investor, a venture investor who's heat mapping that site, that there is customer interest in that. So I think you will see a progression of Kickstarter-like rewards offerings or pre-order campaigns going to whether it's Title III or Title II. And the other point, because I think there's a lot of things that are not understood well about this world. Oculus, which Pelly mentioned, that was a deal that was turned down by Silicon Valley. The crowd got it right on Kickstarter because they wanted to support the gaming technology. And ultimately, it got sold for a big number, as Jerry mentioned. But had Title III been available, and should Oculus have been prepared to accept crowd money, people would have made a lot of money because of the wisdom of the crowd. I'm not saying that's going to be true in all circumstances at all, but it's a very good example of where it was correct.
Yeah. So the idea of sort of starting from Kickstarter and then graduating onto equity crowdfunding,
that's a
later.
great example of it being successful. But we have lots of companies that are first-time founders, or even some that are serial entrepreneurs that want to raise capital this way. This is their first round, or sometimes they've raised venture capital and they might not fit into the traditional VC box where they don't want to give a certain percentage away. They don't want to raise the 10, 20, $50 million. They might just need $1 million, and they want a little bit slower growth. So there's different reasons why people pursue this, but it's very company specific, and it has to be right for your future growth plans.
So who would this not be right for? What kind of entrepreneur, what kind of business is not going to be set up in a way that they would be successful with equity crowdfunding?
Yeah, so as Doug mentioned, there's different processes for whether you want to do Title II, III, or IV. If you're a company that's very stealthy, that wants to keep your product or service under wraps while you're sort of working through it, and you don't want to publicly disclose talking about sort of what the timeline is, then it's not a good fit for you. Likewise, if you're a company that has a lot of interest from VCs and you can get funded, in a week or two, and it's a good, valuation, it's a good term sheet, and it's someone that you want to work with, then you should work with those firms.
It's pretty important if you're going into crowdfunding that you're willing to communicate with your crowd.
Yes.
Yeah. Okay. So one thing, what is in this for the investor? I don't know. Do we have some entrepreneurs here? We also have some investors. I think maybe potential investors. Why would investors be interested in this? What is different in this
Sure.
capacity for them?
So for most of the last 80 years, venture as an asset class has been really difficult for the average investor to get in unless you're a high net worth individual, unless you get the deal flow. If you're part of an angel group or you invest into VC, you just didn't have access to this asset class. And now with investments coming online, the minimums are much lower, whether it's $1,000 or in some cases even $100, and you're able to get into deals, support products and ideas that you really back, that you support. And it's a great way to get into an asset class that previously was, barred.
I wrote an article last Wednesday where I interviewed Deborah Jackson of Plum Alley, which does offline syndicated investments. And she made a really important point about investing in private companies. The general public market has given mediocre returns, and it's pretty volatile these days. So it's no longer, well, it's never risk-free, but it certainly is it's more risky than it used to be. And people enjoy investing in private companies. So people get a personal satisfaction of seeing, of helping somebody achieve the American dream. And you can do that with this asset class. If you want to see products, so in particular for women, if you want to see products that meet your needs, this is a way of making sure you get the products that meet your needs. So from an investor standpoint, there's other things besides just the monetary return.
And Kat, what I would add to that is, I'm going to give you some names of platforms so people can go see. If you're an investor, you can proactively go see deal flow as opposed to a friend. Pelly calls me up and says, hey, I'm going into this deal. Would you be interested? How much are you in for?
Yeah.
But if you want Israeli tech deals, you go to Our Crowd. That's their vertical. If you want consumer products, you go to Circle Up. If you want real estate, which may not be interesting to this audience, you would have made more on a return basis last year than had you had your money in the public markets. You can go to Realty Mogul or Fundrise to look at that. If you want local deals, I'm not going to give specific names, there are platforms that are going to be devoted solely to those verticals. And if you want really good deals, you can go to Seed Invest.
Yeah. So transparency is a huge piece of this. Transparency from the investor side, transparency from the entrepreneur side, really clear communication. So how is this going to fit in? This is for all of you. How is equity crowdfunding and the new generation of equity crowdfunding, which is only, what, now 3 weeks old? I think the laws came into effect about 3 weeks ago. How is this going to fit in with venture capital, with angel investing? How is this all going to live together?
I'll start it.
Okay.
So I think the point really is that you need to know what your financing options are. So I would advise understanding first all of the options, because there's more options, more buckets of money available. So what this has done is really allowed for more pools of money to be available to entrepreneurs. So that's the really big news about all of this, and understanding where you fit in it. So some of that is personal, meaning how fast do you want to grow, how much of your company do you want to give up, is appropriate for you to really seek outside financing. And so you have to do a little soul searching first. You have to understand your business objectives, and then you can evaluate each type of funding, each type of funding option. So rewards-based, as I said before, is right for some of you if you have gadgets. For others of you, it may not be right, and maybe you have to go directly to Title II or Title III. For others of you, you know what? An old-fashioned loan might be the best thing for you. And you may not qualify that, through a bank, but you might be able to do that through Title II.
So the way I would answer it is, I think Title III, which is the up to $1 million through the funding platforms, is competitive with friends and family, and to a lesser extent, angel investing. I think Title II is competitive with angel investing because it's accredited investors. Title IV is issuers that are trying to raise money from their affinity group after going through this SEC process, which I think it's what we call a self-underwritten offering. So I think it's different. It's not competing with VCs or angels, actually, although I think they would hope that angels would invest in those deals. So the whole point of an alternative securities program is to fit a niche that's not currently being served. So while it will be competitive to some degree to each of those communities serve a function, and to where they're doing it well, they have nothing to worry about, and we're creating a farm team of new opportunities for all of them.
And to sort of add to that, a lot of times when a founder approaches Seed Invest, they have the misconception that they have to go 100% equity crowdfunding or bust. And that's definitely not the case. There are different rounds that you can participate, whether it's at the very early stage doing a Title III raise and then going to a more traditional VC route. There are different sort of steps for what's most appropriate for your deal and at the right appropriate sort of stage for growth. So that's...
Okay. So we have about 5 minutes left. If anyone had any questions, I know there are some mics over here. Did anyone have any questions from the investor side, from the entrepreneur side? Sure?
A little bit of both. Gary, you mentioned that you could do the reward side first and then later shift over to the equity side. Does that present a problem for investors on the equity side later that they have to clean up with the reward side? Is there no conflict there?
No, as Doug was saying, it proves traction. So actually, angels and venture capitalists are really looking for that. So even if you watch the Shark Tank, the sharks feel if you've already done a rewards campaign and you've been successful at it, the sharks say, "Oh my God, you've got an audience, you've got customers." The same with other VCs and the same with other angels.
So the second part of the question, moving from there, do you run into a problem where if you've done equity crowdfunding and you want to go to, say, a Series A or a Series B with a traditional VC, do you run into the same issue there?
So I'll take that. So we hear that a lot, and that may prove true on occasion, but the platform that's probably had the most experience with a variety of investors on the platform is Our Crowd. They don't just accept accredited investors, but they have angels, venture investors, and actually corporate strategic investors, which 4 years ago, when we all started off on this crowdfunding journey, the narrative coming out of certain parts of this country was, it'll never happen, they will never co-invest together, and if it's a good deal, they will, and it has. That platform, Our Crowd's had 5 exits, 1 IPO called Rewalk, generally considered a very good platform, and I don't think that the crowd has to be taken out, although there may be circumstances where they are, but I don't think that's any different than when an angel investor group gets taken out by a VC.
And one more point I want to make about rewards. Rewards can be done at the very beginning, or they can be done if you're a huge, large corporation. So anytime you launch a new product and you want to pre-invoice, you can do it. GE does it, Whirlpool does it, lots of large companies do it. They're doing it because they want the market intelligence. They want the research insights that they're getting it. You know, small businesses are doing it because they need the money to manufacture the product. But Pebbles did it. The first time they did it, they raised $10 million. The second time they did it, they raised $20 million.
Thank you.
Maybe we have time for another question. Anybody else? Sure.
For Title III and IV, if you scale to a certain size, I think there are registration requirements. What is that? What are the requirements? What size you can get to before you have to register? And would that be a roadblock or a reason why a company that wants to scale to a large size would avoid using crowdfunding at all?
Well, in particular on Title III, you're referring to the $25 million of assets issue that then triggers registration. And we fought lots of battles with the SEC over that particular provision because we think that that is a problem from having later stage deals with VCs involved and then also the crowd involved just for a small piece. which we thought was a good thing to have VCs, later stage companies, and unaccredited investors coming in at that stage. But it's definitely an issue that you've got to be cognizant of. It's just that through all the gyrations with the SEC and FINRA, we couldn't get them to move on it. So it's an issue.
And there was a lot of negotiation with this. The Jobs Act was passed in April of 2012, is that right? So, and May of 2016 is when we finally had the rules. So this has been a long process.
And you're trying to fix it. Title 2-3 at least.
Patrick McHenry, who everybody should know from North Carolina, has been an outstanding proponent for crowdfunding. And he already has a bill before the House to fix some of those provisions. That is a provision that we brought to his attention. I'm not sure that that's actually in there, because in the scheme of where the legislation originated from, that just wasn't a big issue, even though I think it should be. I don't disagree with you, but at the same time, it was really for startup companies to be able to get started. And if you get to $25 million of assets, there's an argument at that point that maybe you should be registered.
All right, well, we are in negative time. Can we please give our panel a hand? Okay. All right, thank you guys, and we'll see you around the next couple days.
Another round of applause for our panel. All right, guys, just a quick housekeeping note. Just when we do Q&A, there is microphones on both sides of the room, so in case you want to speak into them during the next Q&A, feel free. And we are about to enter into our next round of pitches, so get ready.